Welcome to Markets in a Minute. My name is Austin Duke. I'm financial advisor and chief investment officer for Diamondback Financial Services. We are an investment advisory firm focused on clients who recognize the need for solid investment advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, August 18th, 2025 edition. Let's get started. All right, we start by looking at the stock market as measured by the S&P 500. This is the 500 largest companies in America. Stocks will go up and down on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. The market was up about 3.4% for the prior 2 weeks, which was very surprising to us considering how bad the economic data surprises were on August 1st, that Friday, a couple weeks ago. But the market overcame the negative information and I guess maybe translated that into the expectation for interest rates to come down, which tends to help stock price valuations go up. If we look at the contribution to total return for the market over the past 2 weeks, we see that Apple had a pretty good 2 week period and made up about 24% of the total return for the market. Now, these names that we're going to see over here are very similar to ones we've seen over the past 2.5 years. We call them the Magnificent Seven. And this artificial intelligence theme has regained some traction here in the month of August. We think that clarity on tariff policy has given us an idea of a ceiling on tariff rates. And even though it's a dial that President Trump can turn up if he's trying to get something he wants, or he can turn them down if he works a deal with somebody, then we at least feel like we've hit a ceiling, and hopefully because we've seen some deals get worked out, we'll see those tariff rates come down, which could lead to higher stock prices as well. So Apple reported earnings on July 31st, and Tim Cook went to the White House where he's been trying to help work deals on bringing things back to the United States or investing in the United States. And Apple's had a really rough 2025 because they got a lot of operations in China, in India, where we've seen some of the larger tariff rates across the world. So there's Apple's still down for the year, but it had an amazing 2 week run, which again contributed about 24% of the overall return for the market. And these top five stocks made up half of the return. So again, the AI theme, artificial intelligence, Warren Buffett placed a big stake in United Health, so they had an amazing run for the last 2 weeks as well. But that's pretty much what we've seen for the stock market over the past 2 weeks. Next, we'll look at interest rates as measured by bonds issued through the U.S. Treasury Department. We feel interest rates are the preeminent measure of investment risk, and rates are factored into valuation calculations for most investments. This chart shows us interest rates for a given maturity date. So interest rates listed over here on the left, maturity dates on the bottom axis. So each point along this curve is an interest rate for a given maturity length. The green line is where we were as of Friday, August 15th, and the brown line is where we were 2 weeks ago. So what we've seen over the last 2 weeks is kind of an interesting phenomenon where it's what we call a twist in this yield curve, where these short-term rates have started to come down. At the same time, these medium and longer term rates have gone up. And so right here in between 6 months and a year, we'll call it 9 months, is where we saw the twist point. Jerome Powell is chairman of the Federal Reserve for the next 9 months. His term ends in May. And we are anticipating that the next person that President Trump appoints to that position is going to lower interest rates if these rates on the short end haven't come down by then anyway. So I think what we're seeing is the market starting to react to the possibility of lower rates over the next 9 months. And we would hope that we have what we would consider a normal yield curve where the short-term rates are lower than the medium and long-term rates. We want people to get the benefit of that time value of money. If they're going to put their money or they're going to invest their money for a longer period of time, they're going to get a higher interest rate to compensate them for that time, where we haven't had that in the last couple of years. The Federal Reserve raised interest rates in 2022 and have kept them pretty high since then. And so those who have had savings accounts and money market accounts have been able to benefit from that as well. Um, Again, the economic data that came out a couple weeks ago, the payroll employment data, suggested that things are not as great in the employment world as we thought during the summer. So we are now expecting when the Federal Reserve meets in September that they will most likely reduce their interest rate by 0.25%. Almost a 50-50 chance that they'll do it again in October, and then two cuts of 0.25% by the end of the year. We still think it would be appropriate for them to cut at every meeting and give us the three cuts. We had forecasted 3 to 4 through the year, but we think that the economy can benefit from at least three between now and the end of the year. All right, for our investment implications and expectations portion, I think we are cautiously optimistic that the stock market will continue to move higher. When we got the economic data with negative surprises a couple weeks ago and the stock market came down on that Friday, we felt like we needed to be a little bit more cautious, right? If you're driving on the freeway and you see some stuff happening ahead of you, the first thing you do is take your foot off the accelerator. You don't necessarily hit the brakes, but you're just gonna kind of feel out the situation and figure out what you need to do. So that's what we did. We had been anticipating doing some rebalancing in accounts and reallocating to some other investments. We said, let's wait a second. That first week, the market went up, and then it was continuing to go up this last week. So we took advantage of the higher levels to say, okay, maybe there's enough calm in the markets for us to go in and do those rebalancing. So we did that. Second quarter earnings have been good, better than expected. Companies are reporting better earnings and revenue, and they are reinstituting guidance for the upcoming 12 months. Now that we've got some clarity on these tariff rates, companies are feeling a lot more confident in saying, okay, based on these rates, this is what we think we're going to do in the 12 months going ahead. So we're optimistic that things will continue to go well for these companies as well. It's interesting if we look at what happened during the financial crisis of 2008, 2009, as well as COVID in 2020. There's a lot more similarities with what we call the tariff tantrum of the first half of the year to COVID, where it was more of a supply side issue. So we had a demand side issue in the financial crisis. People lost their jobs. They didn't have money to go out and buy things. And so the price of goods and services came down, the economy contracted, and it took us a while to get out of it. With COVID, supply chains shut down. So we had demand. People were trying to spend money, and the government gave us a whole bunch of money, right? They printed trillions of dollars, and we went out and tried to spend money on goods and services that we couldn't buy because the economy of the world basically was shut down. With the tariff tantrum, it was kind of similar. Like we still had demand for things, and we still wanted to import things from China and from other places across the world, but now we have this man-made tariff rate that's increasing this economic shock of basically shutting down the supply chains again, or at least the appearance of shutting down supply chains. The difference for us is that we don't have this huge influx of money, right? The government's not printing trillions of dollars and putting it in our checking accounts again. So we're being a little bit more selective in what we purchase, right? If we had something that we were importing from one country, maybe now we're importing from another country, or we're sourcing it from here in the United States. And so there may be price increases for some things, some goods and services, but if we're not spending our money on some things and we're spending it on other things, so the overall effect on inflation could be very muted because we're seeing price increases on some and decreases on others depending on where we spend the money. So we feel like the inflation tends to be more the result of how much money is in the system. And again, like the employment situation is not great. People aren't being laid off in droves, but they're having a more difficult time finding work if they're laid off. or leave the workforce. They're not getting pay raises like we were getting coming out of the COVID pandemic. So um, anyway, so we're anticipating that inflation, we may see an increase in inflation in the next couple of months as these tariffs actually take hold, but we wouldn't be surprised if by the end of the year we're back to a 2%, 2.5% type inflation rate on a month-to-month basis. We're seeing increasing expectations that the Federal Reserve is going to lower interest rates, and so again, cautiously optimistic that if we get that kind of rhetoric from the Federal Reserve, that we'll actually see those rate cuts take place, and so the market should continue to rise from that. The Federal Reserve will be meeting in Jackson Hole, Wyoming. They always do every August, and so we may be able to get some clarity or some forecasting of what they're going to do at their September meeting there. But we're seeing a lot of momentum or a lot of reasons that we could experience momentum heading into the end of the year. So this tends to give us caution and say, okay, well, what are the things that can go wrong? And how can we make sure we're positioned to not get caught unawares? But if President Trump meeting with President Putin on Friday, there's a chance, right? He's been trying for the 200 days that he's been in office and claiming that he could have ended it on the first day. Um, there's still a chance that this war between Russia and Ukraine could come to an end, which we think would lift all markets across the world. So I guess the expectation is, steady as she goes. We're going to keep invested in the funds and the investments that we think are best positioned for the next 6 to 12 months. And until we see a reason that we want to put the brake on, we'll keep heading down the road. So that's going to do it for today. No final word, no analogy other than the driving analogy. Thank you for your time, and I hope you have a good couple of weeks, and we'll see you soon.